Hello everyone. Today, we are going to talk about something very interesting. Imagine this. A very powerful and famous leader tells everyone, in the future, you should buy stocks. That makes us think, why would someone say that? What are stocks? And how does money grow in the future? Today's video is like a storybook open book. No hard words, no confusing English, just a simple story anyone can understand. Let's start with a simple question. What is money? Imagine you have chocolates. You give a chocolate to your friend, and your friend gives you a pencil. This is called exchange. Long ago, people traded food for clothes, milk for vegetables. But this was hard. So people said, we need one thing that everyone accepts. And that thing became money. Money is a promise. A promise that says, you can use this to buy things. Now imagine you and your friends start a small business. You open a lemonade stand. You need water, lemons, sugar, but you don't have enough money. So you say, anyone who helps with money will get a share of the profit. This is called a company. A company means people work together. They put money together. They try to earn more money. Now imagine your lemonade company is cut into 10 equal pieces. Each piece is called one stock. If someone buys one stock, it means, I own a small part of this company. If the company sells more lemonade, becomes popular, then the stock price goes up. But if people stop buying, the lemonade tastes bad, then the stock price goes down. Why do people buy stocks? People buy stocks because key cap 1, their money can grow. Key cap 2, it helps in the future. Key cap 3, money works for them while they sleep. But remember, stocks are not magic. Sometimes you win. Sometimes you lose. That's why learning is very important. Cliffhanger. Now comes the big question. If a powerful leader says, buy stocks for the future, does that mean they know something about the future? They want the economy to grow. They have a secret plan. Now it's time to go deeper. Because stocks do not move on their own. Markets do not rise or fall by magic. Behind every market move, there is power. Behind power, there is government. And behind government decisions, there is the economy. To understand why leaders talk about stocks, we must first understand how governments and markets are connected. What is the economy? The economy is not just charts and numbers. The economy is people working, businesses producing, consumers spending, governments collecting taxes. Think of the economy as a living machine. When all parts work together, jobs increase, businesses grow, people feel confident. When the machine slows, jobs disappear, businesses close, fear spreads. Governments watch this machine every single day. Why governments care about businesses? Governments need money to function. They need money to pay for roads, schools, hospitals, defense, public services. But governments do not create wealth on their own. Businesses create wealth. People create value. When businesses grow, they hire more people. They pay more taxes. Government income rises. When businesses struggle, unemployment rises. Tax income falls. Governments face pressure. This is why governments care deeply about business success. The stock market as a signal. The stock market is not the economy itself. It is a signal. When markets rise, investors feel confident. Businesses feel optimistic. People spend more. When markets fall, confidence drops. Spending slows. Fear spreads. Leaders know this. That's why markets react not only to data, but also to speeches, promises, and policies. Words alone can move billions. When a leader says, the future looks strong, markets listen. When a leader says, invest, build, grow, investors react. This is not accidental. Leaders talk about stocks because rising markets create optimism. Optimism creates spending. Spending boosts the economy. A strong market makes leadership look competent and stable. That is political reality. Elections and the economy. History shows a clear pattern. Before elections, leaders want confidence. Markets are encouraged. Positive messaging increases. A strong economy helps leaders gain public trust, secure votes, maintain control. This does not mean markets are fake. It means markets are influenced. Politics and money are always connected. Short-term versus long-term thinking. There are two types of thinking. Short-term thinking, quick wins, fast market boosts, immediate confidence. Long-term thinking, sustainable growth, stable systems, Future security. Leaders often focus on the short term. Investors must think long term. This difference is critical. Introduction to inflation. Now comes a silent force. Inflation. Inflation means prices slowly go up over time. What cost $1 years ago may cost $2 today. This happens when too much money exists. Production cannot keep up. Purchasing power weakens. Inflation affects everyone, quietly. And governments fear inflation more than market crashes. Government tools. Governments and central banks use tools like interest rates, spending policies, money supply control. Each decision impacts savings, investments, markets. Sometimes these tools help. Sometimes they create new problems. Markets react instantly. Ending cliffhanger. So here's the real question. If governments influence markets, if inflation quietly destroys savings, if leaders talk about stocks for strategy, then what should ordinary people do? Should you trust cash? Should you trust stocks? Should you protect yourself differently? In part 3, we answer this by explaining why cash loses value, why assets protect wealth, how inflation changes behavior, how different classes survive economic shifts. We saw how governments influence markets, and why leaders care deeply about economic confidence. Now we face the most important question of all. What happens to your money over time? Because the biggest risk is not market crashes. The biggest risk is something quiet, slow, and invisible. It's called inflation. Inflation does not feel dangerous. There are no alarms, no sudden warnings. Prices simply rise. The coffee that cost $1 becomes $2. Rent increases. Education costs more. Your money still looks the same, but it buys less. This is how wealth disappears silently. Cash feels safe. You can touch it. You can count it. But safety is not the same as protection. When inflation rises faster than interest, savings lose purchasing power. Fixed incomes suffer. Long-term savers fall behind. Cash is stable in number, but weak in value. Many people believe, if I save more, I will be safe. But saving without growth is like standing still on a moving road. Even disciplined savers lose ground. If their money does not grow, this is not a failure of effort. It is a failure of understanding. An asset is something that grows in value or produces income. Examples include businesses, stocks, real estate, productive systems. Assets move with inflation. Cash does not. This is the key difference. Wealthy individuals focus on ownership, long-term growth, systems, not salaries. They understand that money must work, or it will decay. This mindset is taught, not inherited. Many fear market risk, but the real risk is doing nothing, avoiding growth, ignoring inflation. Volatility is visible. Inflation is silent. One feels dangerous. The other truly is. This is not a message to gamble. Wealth protection means balance, diversification, patience. Smart strategies do not chase quick wins. They protect purchasing power. Time is the most powerful factor. Compounding works quietly. Small growth becomes large. Patience beats speed. Those who start early gain time. Those who start late pay. Every person faces the same decision. Trust cash and lose slowly. Or understand assets and protect value. This is not about becoming rich. It is about not becoming poor by default. We will reveal real-world examples, historical proof, how different classes survive inflation. Because the future does not reward comfort. It rewards understanding. We learned a hard truth. Money does not disappear suddenly. It fades quietly. Now we ask the most important question. Has this happened before? The answer is yes, many times. History is not a story. It is a pattern. Every economy moves in cycles. Growth, peak, slowdown, recovery. These cycles repeat. Not because people are foolish, but because systems are human. Boom creates confidence. Confidence creates excess. Excess creates collapse. Collapse creates fear. Fear resets the system. Then the cycle begins again. In the 1930s, the global economy collapsed. Banks failed. Jobs disappeared. Savings were wiped out. Those who held only cash or only wages suffered the most. Those who owned productive land, businesses, essential assets survived better. This was not luck. It was structure. In the 1970s, inflation exploded. Prices rose faster than salaries. Savings lost value. People who depended on fixed income fell behind. Those who owned real assets, businesses with pricing power, adapted. Inflation rewarded ownership and punished passivity. In 2008, markets crashed. Homes collapsed in value. Banks failed. Fear spread globally. Many sold assets at the bottom. But something important happened next. Markets recovered. Those who held quality assets and patience rebuilt wealth. Those who exited permanently never recovered. In 2020, the world stopped. Governments printed money at record levels. Markets fell, then surged. Inflation followed. Once again, cash lost value. Assets protected wealth. The pattern repeated quickly and clearly. Economic shocks do not affect everyone equally. Lower class depends on wages, has little margin. Middle class saves diligently, vulnerable to inflation. Upper class owns assets, benefits from recovery. This is not opinion. It is history. When money is printed, asset prices rise. Wages lag. Those who own assets gain first. Those who rely on income gain last. This is how inequality grows, quietly and legally. Understanding this changes everything. History does not punish effort. It punishes ignorance. Every crisis sends the same message. Own what survives inflation. Avoid standing still. Think long term. We will focus on practical mindset shifts, building resilience, avoiding common mistakes, thinking like a long-term survivor, because the future does not belong to the fastest or the smartest, but to the most prepared.